Objectives for today is to understand long-term planning, why that is important, understand compound growth, what does that mean for you, understand retirement accounts, and also build and invest in roadmaps. So if you were here in weeks 1 and 2, we talked about your budget. And so when we're talking about, building that financial plan in this week, you would have already learned the fundamentals about putting all of this on paper, getting what you need, or put it in your plan so that when you start for doing your investing, you already have that roadmap. So, what is investing? I know there's not a lot of people out there today, but if anybody wants to tell me what's investing, even the workers, you could tell me what is investing to you? Say it again. Putting money into something hoping for a return. Anybody else? What is investing to you?
Putting funds in instruments hoping for a return.
Yeah, so somebody else said the same. Putting money into instruments and hoping for growth, right? So you want some return. So that's really what investing is. Investing means putting money into assets, right? That may grow over time. And that's the goal. That's what investing is. So anything you put your money into, people talk, I think it was in week 1, we talked about high yield savings account. Even something as simple as that is investing. Your returns are not that great, but it's still a return that you're hoping to get. The same thing like if you do a certificate of deposit, which is a CD, you put money in an account like that and you get some kind of return or growth over future. So that's the idea. What do you think are some types of investments? What are some types of investments? CDs. What is it? Stocks. Yep.
Low risk.
High risk, low risk. What type of instrument though? What would be a high risk and what would be a low risk?
I guess
Stock.
individual stock.
Individual stocks can be risky.
Low risk. Banks.
CDs could be low risk. Okay. Government papers could be lower risk. Stocks and bonds, higher risk. What did you say? Real estate, low or high risk. Could be either, right? It could be either. I mean, the one thing that you could think about, and we're going to go through, so those are some good examples of investment instruments or types of assets that you could put your money into. Real estate is one of those good ones too, even though the value may change over time. Ultimately, if you have some land, the property is sitting on some land, land doesn't usually depreciate in value. So that could be a good asset. So ETFs, we talked about a little bit about that in week 1, but exchange traded funds. And anybody understand what that is and what it does? Exchange traded funds. Do you understand what an ETF is and what it does for you for your investment?
ETF is something you're investing in. What kind of money goes to companies that
Is diversified, right?
actually cash out that day or supposed to place it.
Exactly. So ETS gives you almost instant diversification. So when you're thinking about investing, it's important to be diversified. Even if you're buying stocks, don't just buy one category of stocks like technology or real estate or whatever. Make sure that it's diversified in different types. So if you're doing like technology, maybe do technology, but also do some real estate. Maybe you do the different types, conglomerates, different types of instruments. So not just tech, not just real estate or the different types that they have, but just make sure that you're buying different instruments in the event that the market goes down, right? If the market gets affected and that one area is affected, your whole portfolio doesn't tank. So it's important to be diversified. So retirement accounts, if you have a 401k, a lot of people think nowadays it's not good to invest in that. But if you have a 401k and your company matches, you want to use those funds because, again, they're giving you some money, right? And we said real estate businesses. That's another form of investment. Do you understand that you could invest in a business, right? You could start your own business. And we talked, I think it was last week when we talked about diversifying your income. But outside of just diversifying your income, when you have a business, that could be an investment, because if the business performs well, then you have money that you could pass on to your children, your grandchildren later down the line, right? So that's also important. Dividend investments. So you want to invest, or at least try to invest in instruments that have some form of dividend payout. Now, if you're not close to retirement age, then you won't be taking those dividends just yet, right? But what will happen if you have a dividend fund is that they'll reinvest it for you, right? So the payout comes, you'll see it in your account. If you're currently investing, you'll actually see the payout comes in, and then it automatically goes out because they're buying you new shares in that stock or that instrument that you already have. So that's one thing that you should always try to do. So, why do you think long term planning matters? What would be your reason why you should do some long term planning? Why does it matter? Why does long term planning matter?
Because you have long-term goals.
You have long term goals.
And not all of your what you hope to achieve can be achieved in the short run.
Not everything that you want to achieve can be achieved in the short term, right? So, that's one reason why long term planning matters. Anybody else? Why does long term planning matter?
Fail to plan, you plan to fail.
When you fail to plan, you plan to fail. That is a good thought, right? If you don't plan, then you're already planning for failure, right? So it matters because over here, somebody said that it's because, you can't always achieve what you want for the long term. Maybe you want to purchase a home. Maybe you hope to retire comfortably. And how do you retire comfortably without planning for that, right? So it requires planning, and so it's important to make sure that you start, especially when you're younger, because as you start younger, whatever you're putting away into an investment account has the potential to grow exponentially by the time you're ready to retire. So if you're somebody that's in your early 20s, mid 20s, early 30s, you probably have 40, 50 years maybe before retirement. Maybe not. Maybe you want to retire in less than in 30 years, and that's okay by 50, and but you still need to do some form of planning. It's important. So inflation, which we've been experiencing, right, reduces the value of your money. So that's also another reason why you want to plan long term, plan for the future. So it reduces your purchasing power, right? So it will always affect that. So that's one of the reasons why you want to make sure that you plan, right? Because again, when you're experiencing inflation, right, the economy is being affected by all the things that are happening right now, gas prices, the wars, all this stuff, right? You're not, because you're planning for future, right? The money that you put away today may look shaky, right? When you look in your portfolio, you go in, you may see some reds. I think yesterday, the market went back up some gains because different announcement happened. So it's also important to understand when you're investing that what the government does will usually affect your investment portfolio. What happens in the economy will also affect your investment portfolio. What's happening if the interest rate, the government, the Fed decides that they're going to increase or lower the interest rate, that affects. But again, those changes are not static. They change over time, right? So if the interest rate today is 7%, it's not going to be 7% for the next 30, 40 years. It will usually change. Maybe it'll go up higher, maybe it will come down. Those things will also affect your long-term planning goals. So it's important to plan, right? And it's important to make sure that you're at least investing. Now, it's crucial as an individual and as an investor that you do your research. Even if you have a financial advisor, even if you have somebody that's reviewing your portfolio, do your own research, because humans are limited, right? They only know what they know. And there's information that someone may tell you that it may change in a few weeks or so. So it's very important that you do your own research so that you understand what you're putting your money into. Another thing that I had said, I think it was in week one, that is very important when you're thinking about investing, right? That you already have your savings set aside. And we talked about the emergency savings account that you need. It's important to have that. And I think if you weren't here, this is what I said. Make sure that you try to get to at least one solid year of emergency funds before you start thinking about investing. And you have to measure your risk tolerance. Now, if you don't have $100,000 to just lose, which most of us don't put all of your money into an instrument that you didn't adequately research and then could potentially lose, right? So it's important to understand that. Consistency creates what? Flexibility. So if you're consistent, we said it in week one, be consistent with your budget, be consistent with savings, but also be consistent with investing. So if you start it, don't just fall off in month 2 or 3 because you have something exciting that you want to do. Maybe you could adjust the amounts, right? You adjust the amount that you're investing based on what's happening in your life, but be consistent, because when you're consistent with all of your financial goals, you're consistent with budgeting, you're consistent with saving, you're consistent with tracking your spending, then that will create some flexibility for you. Retirement may last 20 to 30 years. Why? Why may retirement last for a very long time? People are living longer, right? So if, say for example, somebody retires at 65 years old, they could live to 100. They could live to 90, and that's happening, and that's a good thing. That's awesome that we're living longer, right? But in that, you need to also plan for those years in retirement. Now, if you don't plan effectively and adequately, and you're in retirement for a full 20 years and 30 years, but your money runs out in the first 5, what do you do? What have you seen? A lot of people who have gone into retirement have had to go back to work. And so that's because maybe they did not plan effectively, or some emergency happened and it wiped out what they thought they would have for their future. So that's why I said it's also very critical to make sure that in your budget plan that you put an amount away that will cover any emergency incidental. It's so critical. All right, so another reason why you want to think about investing, it's because of the power of compound growth, right? You're familiar? The power of compound growth, exactly. So small contributions. I do an exercise, right? I put the videos out on YouTube or wherever, and we talked about it last week. If you spend $5 per day on coffee or tea or that breakfast sandwich or that lunch, I'm sure it doesn't cost $5, but I'm being very conservative and saying you spend only $5 per day on something that we would consider maybe it's a luxury item. You like that premium coffee and it costs you $5, right? If you were to take that $5 and put it into, let's just, for simplicity, put it in a high yield savings account that's giving you maybe a 4% return or something like that. Or maybe you put it in a different type of investment instrument, right? Over a full year, you would have amassed between $1,300 to $1,800 or so, depending on how much your return is, right? So again, think about how that could potentially change your life. Now, a lot of us don't think about that because $5 is small. You go in your pocket, you just pull out $5, you buy one of these